Evan Lucas, Chief Market Strategist at InvestSMART, joins us live. Evan, good to see you. We've seen a bit of data around in the past week or so, and today we will see the trade balance data. What is it likely to tell us?
Yeah, good morning, Laura. Look, it's likely to show, unfortunately, for the fourth consecutive quarter in a row that we are actually declining. Now, I need to probably put a little bit of context around that. We did hit a record 4 months ago. It was sitting at 5.82 billion Australian dollars. Likely to come in at 5 today. Now, the reason we see that decline, exports are actually falling away, and that is partly down to quite a significant downgrade in terms of the amount of imports into China. That's, again, some people would probably relate to the idea that it is also the Chinese-US trade tensions playing into it, but also it's this time of year cyclicality that we actually see the Chinese slow down. The reason it's important is that exports have been a major reason why our GDP this year has probably remained above expectations and likely to probably hold slightly above expectations for at least the next 6 months. So it'd be a nice sort of thing to see. Hopefully the decline isn't as large and that we do start to break out of it, but it is starting to be a bit of probably a headache to start to see that kind of decline if it continued for at least another 2 to 3 month period.
So Evan, how does this feed into tomorrow's statement of monetary policy?
Look, Pete, it's a really important piece, and the reason for it is that what we saw on Tuesday, the reason the RBA didn't cut rates and probably has put the queue on the rack for 2019 is that they are starting to see a gentle change from what they saw midway through the year. We are seeing slight movements up in things like housing, slight movements up in confidence, and then also the GDP figure. However, they are and have already basically downgraded their expectations for tomorrow. So GDP down from 2.4 to 2.25%. Core inflation is likely to be around about 1.4%. That's really interesting considering the Treasurer decided not to change the RBA's mandate of having core inflation between 2 and 3%. What it does basically say is that although they're not going to do it in 2019, monetary policy in 2020 is going to be key. There is, a definite sign that we could actually see not only further rate cuts, but the probability of quantitative easing in Australia is definitely rising if those sort of outlooks aren't met next year or in 2021, and we move further and further into slowness, because it will actually mean that confidence is hit and the country will slow down further still.
In monetary policy playing a key part, as you say, in 2020, but also fiscal policy. We've seen those tax cuts surely wash through the economy. Now, there's some suggestion that it hasn't provided the stimulatory effect that the government promised. What's your view on the effect of those tax cuts?
And Laura, I'm with you. I mean, the $1,080 that we're going to get washed through in this cycle was never going to be enough to really pick up, the speed at which we were declining. That's why the argument from economists, you could also probably put the argument out there that Labor are doing the same thing, that bringing forward the second and third tranches would be much more advantageous to sort of move that. You've also got to point out that, again, the infrastructure spending timeframe on the fiscal side could also be brought forward, and looking, instead of doing it all the way out to 2024, 25, bring it into 2022. That would also very much bring up that stimulus faster, sooner. It would basically make that gentle decline really move through at a slower rate. We could even start seeing a positive movement at a probably into 2021, 22 again. So that's the argument. Fiscal policy is being probably too slow. Yes, it's probably being prudent is the argument from the government, but again, prudency in this kind of cycle is probably not necessarily the right thing to do, and that's why you're going to hear next year a lot more push that fiscal policy needs to be quicker, needs to be more nimble than it currently is.
But despite all of that, the market still remains robust. So how is that?
Yeah, and this is the other part. Everybody's asking that question, why are markets remaining so robust? Probably the point out to it is that all of this monetary policy that we've been talking about has actually pushed other assets, particularly things like bond markets and treasuries, to record lows. They therefore don't return the kind of levels that basically the big super funds, pension funds around the globe need, and that therefore pushes money into things like equities, which continue to obviously offer above trend growth and above trend returns. Now, there is a risk caveat to that, isn't there? And one day it's going to slow down, and that therefore will also see a push. But why those markets remain robust, why they remain attractive on a return basis, they are going to remain at that higher level. Earnings are okay. I wouldn't say they're great, Pete, but in saying that, all of that is why money is pushing towards it. US markets at record all-time highs. We're only 120 points away from our July record all-time high, and that's likely to continue until we see some form of major change, either geopolitical shocks or the slowdown finally arriving.